All right, trade management. And for trade management, I mainly want to focus on the initial stop loss placement and the act of going break even. Now, I want to focus on the two types of entries that we have. Order flow entries, so that's anything from an ST to an ST plus re, ST plus re plus re. And I also want to focus on candle size entries, so stick entries. Perfect. In both those two scenarios, so in both those two entries, the main question that we need to ask ourselves when we have our initial stop loss placement and if we want to go break even is the following. Is there a reason to return? So is there a reason to return towards that level, and can we still expect then higher price off of that or lower prices off of that? That's important to ask yourself. Now that goes quite deep because we understood as well the retracement can lead to low probability conditions, which we discussed in an earlier finishing touch video as well. So we have to understand that from the following perspective. For order flow entries, that's going to be right here from fair value areas and breakaway gaps right there. All right, then here we are on NASDAQ, and I just want to go over multiple entries right here to get the ID going. Now, if we are looking at this sweep and we have 1 hour order flow right here going higher, we have an ST, we have a RE as well, and we are targeting this daily value gap right there. Then let's say we enter off of the first sharp turn entry right there, the first fair value gap. Then where do we place our stop loss? We place a stop loss where there is no reason to return. So where is no reason to return right here? Well, breakaway gaps, do we have breakaway gaps at this moment in time? I would argue not really, but we do have fair value areas. So a fair value area that we have is sitting right here. The full fair value area is this, but if we want to mark it out correctly, then it's this one right there. This is the full fair value area. Now, this is arguably the furthest that we can retrace because this is the current fair value area that we have. And we shouldn't, again, or we could offer fair value to then continue higher, but we should not disrespect that offering of that fair value to then seek that liquidity. So where a lot of people might go wrong initially, in my opinion, is covering the full intermediate term low. So covering the full low that we have sitting right there, which in my opinion, yes, if you are just starting out with trading, I could see why you would do that to get a safe stop loss, things like that. But if we are talking about RR, then this is going to hurt you in the long run because this is going to take longer right there to hit to RR. It's also, it might take you longer if you experience more drawdown right there to go break even as well, things like that. It's going to hurt you in the long run. So why not the full low right there? And why then this low or even the bodies right there? Because the bodies right there are the fair value area. And even there, if we now get a retracement below this area right here, then what is stopping us from not reaching that low right there? Nothing. There's no fair value gaps. There's no fair value area. There's nothing stopping us from reaching the next low right there. So if this low is going, which is an order flow lag, then the full low is going like right there. So that's very important to understand that we are in order flow entries. We're essentially following along with the order flow lags as well, both on this time frame, on the time frame above us, to see what we are doing regarding timeframes above us in the terms of fair value gaps as well. Now, right here, when can we go break even in an entry like this? You can go break even quite early and earlier than most people think. Again, it is quite important to understand, and this is what we're going to touch on at the end of this video as well. It's quite important to understand that the lower time frame doesn't need to be perfect if the higher time frame is just a really good trade ID. So expecting picture perfect lower time frame price action, that's also not the way to go, because lower time frame tends to consolidate a lot more than and then still following through on the higher time frame overall ID. So keep that in mind as well. Now here we see a sting into our entry right there, into the fair value gap. Afterwards, when do we have no reason to return anymore? Well, we have a perfect sting into it that creates this fair value area right there as well. And it creates these fair value gaps sitting right there. So at this moment in time, is there already a reason to return to our entry? Well, we could argue if it's going to be a deep sting into our fair value area right there, then yes, there could be a retracement. There could be a reason to retrace. But at that moment in time, I would say, no, there's no reason to retrace, because the likelihood that we are going to get a deep sting into that fair value area is not very likely in the conditions that we still have high probability conditions. So we still want to actually continue higher. If we don't want to continue higher anymore, and we are going to consolidate, and we are going to or either continue lower as well, then yes, then we will have deep retracements like this. But that's exactly the moment when we also want to be break even, to protect ourselves from the potential consolidation that's coming, from the potential loss that's coming. So when going break even, when placing our stop loss, we are always assuming, and we always want to see ideally, that the high probability conditions are going to continue. So that leads to the understanding that retracements shouldn't be that deep. Retracements shouldn't be that weird overall. Because if we are going to be in high probability conditions, then the following thing should happen. Maybe a sting into the value area, but then immediately continuing higher right there, which is exactly what happens as well. So that is the thought process that we want to have regarding those fair value areas right here. So a similar entry is what we get later on right here as well. When we have a sting into that fair value gap, let's say that was our entry, cover the fair value area low overall, and then afterwards we target a 1 to 2 right there. Now, put it towards the side. Then when can we go break even? Well, I would argue that the moment you can go break even right there is actually based on a stick entry almost, because we have a 2-candle rejection right there in that fair value gap. As soon as we have the expansion phase higher, so this candle right here, we can already go break even. Now this again is really close related to the stick entry method overall of how you can go break even as well, which we'll go over later on. But this right here, what should happen at this moment in time? Well, if order flow is going to follow through, it should ideally create a new fair value gap right there. So that already means that we're not going to trace into the next candle all the way back towards that first candle high right there. That's the first thing. The second thing, if we do create a fair value gap, then most likely it's going to be a sting into a value gap, and then we have also a fair value area above it right there. So that leads us to the understanding, if we do retrace back into that entry level, which again could happen, but is that very high probability to happen? No, absolutely not. So we can already go break even to protect ourselves, where if we do make that retracement, from a consolidation and from a potential loss right there. And that's important to understand. All right, here we are on crude oil. On the daily, we had this target right there. Then if we go into the 4 hour, we see that we had this fair value gap right there that we can continue higher off of. If we now go into the 15-minute time frame, and let's say we just enter off of a 15-minute sharp turn. So let's go over multiple entry examples just purely for the sake of looking at the overall stop loss placement and trade management. Now, if this is our sharp turn entry right there, then where do we initially place our stop loss? Well, our initial stop loss is going to be, again, determined mainly from a fair value area perspective. So the fair value area that we are dealing with is this one towards the left. We also have a nested fair value area, which is sitting right there. So we ideally want it to be below right there. Those fair value areas towards the left and towards the right there. The nested one and the main fair value area. We don't need to cover all the way this low right there, because again, what are we then doing? Well, then it becomes quite difficult right now to reach 2RR, where we might hold this trade for a very long time, and we could have easily hit 2RR right there if it wasn't for our big stop loss placement, even within the context area still right there. Now, when do we go break even? Well, when do we have no reason to return? We create an expansion phase candle at this moment in time, sitting right here. When we create this expansion phase candle right there, that's exactly the moment when we can also say, well, right now we could go break even. Before that, it was quite difficult because we only have stings into candles, but here we have an expansion phase candle of a fair value area. Perfect. We can now look to go break even as well. So if we then move on towards next trade IDs, and we look at this trade right here, and let's say we enter like this, where do we place our initial stop loss? Do we place it below the long wick right there, or can we also place it below below the bodies right there of the candles? If we have long wicks, then I tend to ignore the long wicks right there, even when it isn't no news wick or anything like that, and still place a stop loss below the bodies right there to then target higher as well. Now, when can we go break even right here? We can go break even with the next candle, with this candle already, because at this moment in time, there is no reason to retrace anymore. And if we now create a retracement, that should not happen towards our entry right there. That means that we are most likely going to consolidate, or we are actually going to continue lower. Okay, now if we go into this 15-minute fair value gap and we now go into the lower time frame of the 1 minute, and let's keep in mind this target as well. So what are we doing right here? Let's dive into the 1 minute. If, let's say, we just use again a similar ST entry right here off of that 1 minute sharp turn right there, then where do we place our stop loss at this moment in time? Do we place it below this swing low right there with the bodies? Well, I would argue you can place it right there. Why right there? Because even if we now retrace back into this moment, so that level right there, is there a reason for price to retrace at that exact level right there? In my opinion, no, there is not. So why put stop loss right here if there's already no reason to retrace at this level right there? So put the stop loss right there. And why is there no reason to retrace right there? Because this right here is the fair value area. This is a fair value gap that we have above. And this is the last fair value gap that we have sitting right there. So in the worst case scenario, we have a sting into this fair value gap to then still continue higher. Is it going to be a very deep retracement? Most likely not. But just to keep it simplicity and not refine it too much, we can also have it at the first fair value gap low right there. That is where we can place our stop loss, because again, it's, well, I say simple. If you understand what we are dealing with in different trending conditions, in different consolidations, all the videos that we've gone over in the finishing touch as well, where retracement leads to low probability sometimes. If you understand those different scenarios and you understand breakaway gaps, for example, as well, then you understand where price has no reason to return to anymore. Because this right here should ideally just as well be a breakaway gap. So we can actually cover the breakaway gap right there. And that will save us a little bit of time, because then we hit 2RR quite fast, and we can also go break even right here quite fast. Because where can we go break even? Same exact moment. In perfect price action, you can go break even so extremely fast right here, because it is just a sting into your entry, and then boom, we immediately continue higher, creating a new expansion phase candle, a new order flow lag. That's already when you can go break even as well. Now, what do we do right here? Because we might also, let's say our target is a lot further away. Our target is extremely high right there, disregarding the 2RR, etc. And what do we now do in terms of what the higher time frame is doing? So when we are managing a trade, we're always taking into account the same time frame mainly. That's where the main things are going to happen. But if we need to hold that trade for quite some time, we also need to take into account the time frames above us, but never, again, I mentioned never the time frames below us. That's very important. We're never going to manage a trade from the time frames below us. So 1 minute, well, all the time frames are above us. But if we now take into account 5 minutes for value gaps, 50 minutes for value gaps right there, what actually happens? Well, zooming out to the 5 minute leads to the understanding right here that we don't really have to worry about anything on the 5 minute. Why not? Because on the 5 minute, this is where stick entry method on trade management gets really interesting, what we're going to go over next. Now here, we create this expansion phase candle right there. So if we now, at that moment in time, create that expansion phase candle, and we have this, we could argue, fair value area sitting right here, then can we still retrace back into our overall entry at this moment in time whilst we are getting really close towards this drawn liquidity right there? Worst case scenario, again, let's look at this, is that we have a sting into this fair value gap, which is actually, if we look at the third candle as well, is a breakaway gap. I would argue at this moment in time, we are closer to the drawn liquidity than we are to retrace towards the fair value area to then potentially continue higher. So here, it is already as well a break even, because right now I would not want to see, and again, that's a phrase that a sentence that I'm going to repeat very often, because I say it very often in live sessions. I say it very often in trading ideas overall, in forecasts even. I would not want to see price retrace there, because think about what that means. If we do create this retracement, that means right there we have a retracement where a retracement was not supposed to happen, because we have a breakaway gap right there. We should already deliver higher if we are truly in high probability conditions. So if we do create a retracement, then it's very important to understand that we are approaching low probability conditions, because a retracement should not happen right there. So according to that, we can also see if we actually want to go break even or even trail our stop loss. Now, trailing our stop loss or trailing a stop loss is something I don't like to do. I just like to leave it at break even, and that's it. Then it's take profit or break even from that moment on. Now, right here, we have no reason to retrace. So there's nothing to worry about on the higher time frame right here. Now, let's make this a little bit more difficult, and let's take weird entries that, well, most likely no one would really take. If we take a look at this entry right here, then what should now be our break even and our stop loss? Entries like this, and you will notice if we enter on fair value gap creations, if we enter without having a sting into our entry, so we enter on essentially a buy stop where we see price going higher and we enter off of that, it's always going to be more difficult to have a really clear stop loss placement and a really clear break even level. Now, right here, where can our stop loss, our initial stop loss be right here? Well, worst case scenario, we again create a fair value gap right there. That's what I would assume. We create a fair value gap, we have a sting into that fair value gap, and worst case scenario again, we sting into the fair value area that we have right there to then potentially continue higher. So right here, I want to have my stop loss at that moment in time, at that line right there, at the bodies of that fair value area. And why there? Why not all the way here? Because if we already need to go so far right here into the fair value area, that again leads to me understanding that's very low probability. That should not happen. So if high probability conditions are going to continue, then a worst case scenario is fair value gap sting, or well, not worst case scenario, it's fair value gap sting to then continue higher, or fair value area sting to then continue higher. Can you see how I'm using I'm not too sure which exact video it was. It was one of the previous videos where we go over spotting trends, spotting consolidations, how I'm using that video to also understand what is still high probability, what is still low probability. So how far we can actually create a retracement in the first place, where fair value area is oftentimes the furthest we can retrace. But even then, if we create a breakaway gap now, a fair value area is where I also would not want to see a retracement. So there is no beneficial thing if we now reach this low right here, and let's say we reach this low, and then all of a sudden there's nothing there, there's no fair value gap, there's nothing, no extra area right there where we might say, oh, we can still continue higher off of that right there. No, if we reach this area, we're most likely also going to reach that low right there. So we can refine our stop loss to the bodies right there. And that's important to understand. Again, I also want to touch a little bit on the following. Let's say our stop loss right here does get hit right there and we lose this trade. Then is it appropriate or is it valid to still look for a new trade ID right there? If we are looking from the logical things that we have gone over thus far, and we also look at it from a perspective of spotting trends and spotting consolidations, also the previous videos that we've gone over, then is that very logical? No, because your stop loss is always going to be at an area where low probability conditions are going to kick in. Meaning, if our stop loss is going to be hit right there, that means we are now in low probability conditions, because that should not happen, that retracement. So using or entering another trade afterwards right there is not logical, because you're now entering in low probability conditions right there, and you're forgetting why you are trading in the first place, which is we're trading in high probability conditions. So that's not logical. That's why I always personally have the rule as well. I only take one trade in the full ID right there that we have. And that's very important to understand, because oftentimes something like this might happen. You get stop loss, your stop loss gets hit right there. It still moves in your direction. And the beginner Arjo, the beginner in me, what I used to do is, well, let me still enter that trade right there, because now it's just a sweep and then we are going to continue higher, right? And then something like this happens and we take another loss, and something like this might happen and we take another loss, ignoring the first sign that we had that we might consolidate, which was our stop loss gets hit right there, which means that we are now in low probability conditions, which means that we might actually see consolidation, which leads back to the understanding of spotting consolidations and spotting trends as well. Where the earliest signs, if we ignore those, that's going to come to haunt us, essentially. Now, moving on. When do we want to go break even right here? We create this fair value gap right there as well, potential breakaway gap. Can we go break even right here at this moment in time? Well, even if we do not retrace back into the fair value gap or the breakaway gap that we create right there, we can still have a sting into it in the next candle to then continue higher. So I personally would want to wait another candle right here. Now of course, if that's the target, yes, we can go break even, but the target is a little bit higher right there. The target is, let's put it very high again, right there. Can we go break even at this moment in time? Yes. Why? Why can we go break even at this moment in time? Because what is this line right there? Well, that was a target on the daily. So what does that have to do with anything? Well, that is a target, meaning that is now a fair value area. So the high that we have towards the left is now our new fair value area. Meaning on every single time frame, if we are now going to continue higher right here, then it's going to be off of this fair value area. And if we want to continue lower, then this fair value area high is going to be the cause of that. Remember, because if we are now going to sweep liquidity, we are actually going to sweep the liquidity right there to then continue lower. So this is a crucial level where if we now still want to continue higher right here, we should already be a break even and we should continue higher off the overall fair value area that we have sitting right there. And that is very important, because here leaving this trade open after, for example, the context trade context has been taken, that is very dangerous right there. And then you're going to be in not an ideal trade, let's put it that way. So that is very important to understand. When we reach a context high, for example, like that, we can 9 out of 10 times just simply go break even, because that turns into a fair value area where you then want to see higher prices off of as well. All right, now we have gone over order flow entries and how we want to manage a trade right there through fair value areas and breakaway gaps. Now, if we move on to candle signs entries and stick entries, I wanted to say stick entries right there, then it's going to be mainly understood from the following. A fair value gap. Understand when a fair value gap should form. So fully understanding the candle signs perspective, as in we have the expansion phase, the fair value gap should form right there. What we have done very similar in order flow entries right there, but didn't mention it fully just yet. Those order flow entries and candle signs entries, when you both understand the trade management part for both entries right there, then you can also mix them up. For example, you can use candle signs trade management inside as well order flow entries, or you can use order flow trade management through the understanding of breakaway gaps, through the understanding of those fair value gaps, fair value areas, as well in your candle signs entries. And that is going to be when you reach mastery of trade management, essentially. Now, what we're going to go over later on as well is very important to understand. When you do start mixing them both, most likely you're going to take a lot of early break evens, which is not necessarily a bad thing. Now, we're going to go over that later on. Let's first dive into the understanding of candle signs entries and how we can go break even as well. All right, so staying on the crude oil topic right here, where do we place our initial stop loss and where do we place our, or when do we go break even as well? Let's say our entry is on the 4 hour right here based off of this rejection that we have right there. And we first cover this low. Now I'll show you different methods you can use as well. Let's first go over this one. When do we now want to go break even? Let's put the target a little bit higher again, just to emphasize on the fact when we can go break even. Now you can go break even right here very fast. And that's why in stick entries, relatively seen to the time frame you're entering off of course, the overall time seen, it takes longer to go break even, but the candles, if we count the candles, then it's earlier that you can actually go break even. Meaning, right here, if we enter on this down candle, and then we continue higher right there with an expansion phase candle, we can already go break even at this moment in time, because right now we have an expansion phase, and right now the order flow comes in very beneficial as well, because we understand this right here is now a potential fair value gap. Perfect. This is now the fair value area. The bigger fair value area is the target that we reached on the left, and we have a nested fair value area sitting right here as well. So there's zero reason at this moment in time to return right here. So this is indeed a break even. Now, if we refine this a little bit more, because I actually entered a little bit different right here, because I also took an entry, and I entered in the following. I entered with, I believe, approximately around that time right there. It was not at the exact moment of the 4-hour close when I was looking to trade right there. So I entered a little bit later. Now, right here, I did not place my stop loss below the 4-hour low right there. I placed my stop loss at that right there, at the bodies. And why at the bodies right there? Well, because I understood again, if we do at this moment in time right here, if we now create a retracement back all the way towards these lows right here, then I know we are just in low probability conditions and we are not following through off of the overall 4-hour fair value gap higher right there. So for me, this stop loss placement is a little bit refined, a little bit more advanced, but I understand if we do retrace back there, that's going to be low probability conditions. So what you'll see me do oftentimes in stick entry as well is you will see me refine. So I base the entry off of one time frame, of the 4-hour time frame, and I refine my stop loss a little bit by going down one time frame to cover the bodies instead of the full candles right there, instead of the full wicks. Now, when can we go break even? Right here. Let's see. We have this expansion phase right there, and that expansion phase in itself already, again, is enough to right now go break even, because we understand a fair value gap formation right there. And the fair value gap right there, once we get that, an expansion phase, we get a potential fair value gap. That in itself, even if we do not create the fair value gap, well, that's exactly the reason why we go break even. Because we want to protect ourselves right there from whatever may happen, from whatever low probability conditions we may get. All right, going over Euro Canadian dollar, where I actually took a break even as well. If we have this daily fair value gap right there, we can enter off of that with a stick entry. This right here was my exact entry. Now, I went into the 4-hour, like explained in the previous example, and I actually covered the bodies right there of those candles. Why the bodies? Again, it's a small difference right there, but it still saves you some overall time that you need to be in the trade ID. So that's perfect. That's exactly what we want as well. So my 2RR was right there, which my 2RR might seem like it was a hit, but due to spread, due to news, etc., my take profit actually did not get a hit, which is a bit of a shame, but it is what it is. Now, when do we go break even right here? For stick entries right here, we can also take a look at the time frame that we are using to enter on. And yes, we can make a little bit more use of the time frame below as well. But right here, it was mainly based on a daily entry. So I look at daily. If on the previous example, I mentioned is mainly 4-hour example as well, or 4-hour ID as well, but I used a 1-hour entry. So it's a small difference because I'm entering on 1-hour candles, meaning I also want to manage that trade from the 1-hour perspective. Here I'm entering on a daily candle. So I want to enter, or I want to manage the trade from a daily perspective as well. Very important. All right. Now right here, when can we go break even? Well, when are we expecting a fair value gap to form? And when is there no reason to retrace anymore? This right here is the first target. Right there. This low right there. Now, I would argue as soon as we reach that low, so with this next down candle, we can already go break even. Why? Because here, even if we do not get it, and that's even more reason to go break even right now, this should have been an expansion phase candle right there. And we do not get that expansion phase candle right there. So I already want to be break even. From a stick entry perspective, it's just simply understanding where should a fair value gap right now form. If we get now up candles, etc., we know we should already be break even just purely from that daily candle perspective right there. That's the most reason, that's the best reason we're going to get right there to go break even. Now, if you're interested in seeing more examples of this, because we can go on and on and on, and I do think that's beneficial because that's exactly what we do in the live session as well. I don't like signals, but I do like giving risk management signals because it's quite fun as well. And usually I am, well, I would argue most of the time I am correct in my break-even placement as well. And that is purely from one thing and based on one thing. That's purely from experience. You will have a break-even journey right there. Now, in your start of your trading journey, in my opinion, go break even as early as possible. And take a few break-evens. Take break-evens that turn into winners. That is very good because, yes, of course, you missed a winner, but you will get a hang of that break-even. You will get a hang of that risk management, that trade management, and that's important. Now, right here, you're most likely going to start right there. You're going to break even too early right there. And why too early? You don't have the experience just yet. You don't have that intuition just yet on where your overall break even should now be. You don't have that, yes, you can say, okay, well, right here I would go break even, or you have a good understanding of where we have no reason to retrace to anymore, but you don't have the full experience yet in a live market. And that's quite a difference. So most likely you're going to break even too early, and too early as in you're going to miss winners. You're not going to prevent losses. You're actually going to miss winners. You're also going to prevent losses, but you're also missing winners, which leads to you overall missing out on RR, missing out on profit. Then my advice would be go to the other side of the extreme where you are now break even too early, go to break even too late, or no break even at all. So take profit or stop loss right there. And then from that experience, we now will also take losses that could have been an easy break even. But that's good. Again, that's also good because you can learn from that. And then you take the trades that you took and you gather the data. You journal the trades like we do as well at the end of every month. And then what you want to do is you want to see, okay, well, when can I go break even right here? When is it not too early? When is it not too late right there? And then find the middle of those two extremes. And that is where we have the word perfect. We move on to perfect. That's the green zone, essentially, where we are now really good at understanding, not going break even too early, but also not too late. So we have found the balance right there. When you are just starting out, you are most likely, again, going to require picture perfect price action from the lower time frame to candle rejection. You're going to mix in all different concepts right there to go break even extremely early. And you might miss some winners because of that. When you do notice that, become more loose. Remove the break even rule for a while just to see what happens right there. Remove or go break even a very late, as soon as we are very close to your take profit, something like that. And then from that, we can also find again that perfect balance in the middle when we can actually go break even perfectly. Again, break even, I would argue half of it, well, more than half of it is also experience and seeing where you can go break even and can't go break even. Because but if you use the tools that we have given you in this video, then you will get there for sure. All right, perfect. Thank you.